Imagine this for a moment. A monkey walks into the stock market. He doesn't know anything about finance. He doesn't understand stock charts. He has never watched financial news. But somehow, this monkey ends up making more money than many professional traders. It sounds crazy, right? But the interesting thing is that this idea actually reveals a powerful truth about how markets work. Most people believe the stock market is extremely complicated. They think you need secret strategies, advanced analysis, and perfect predictions to succeed. They believe successful investors have some kind of hidden knowledge. But the truth is often much simpler. In finance, there is a famous idea called the monkey portfolio experiment. The concept is surprisingly simple. Imagine a monkey throwing darts at a list of companies in the stock market. Wherever the dart lands, that stock gets selected for the portfolio. The monkey is not analyzing anything. There is no strategy, no prediction, and no understanding of the business. It is completely random. Yet, in several discussions and theoretical examples in finance, researchers have shown that randomly selected portfolios can sometimes perform just as well as the portfolios created by professional investors. Now think about that for a moment. Highly educated analysts spend years studying the market. Investment firms hire experts with advanced degrees. They use powerful computers and complex models to analyze companies. And yet sometimes a random selection of stocks can perform similarly. Why does this happen? Because many investors make one critical mistake. They try to predict the market too much. People believe they can perfectly time when to buy and when to sell. They watch financial news every day. They react to every headline. When the market goes up, they feel excited and buy more. When the market falls, they panic and sell. But markets are influenced by millions of people around the world. They react to politics, global events, economic data, and sometimes pure emotion. Even professional investors cannot consistently predict short-term movements. This constant attempt to predict the market often leads to emotional decisions. Fear makes people sell during crashes. Greed makes people buy during bubbles. And these emotional decisions destroy long-term returns. Now, here is the interesting part about the monkey example. The monkey's advantage is not intelligence. It is the absence of emotion. The monkey does not panic when prices fall. The monkey does not chase hype when stocks are trending. The monkey does not try to time the market. The monkey simply holds the stocks. Over long periods of time, the stock market historically tends to grow as businesses expand, economies develop, and innovation continues. On average, global stock markets have delivered roughly 7 to 10% annual returns over long time horizons. This means patience often beats prediction. Let's imagine two investors. The first investor constantly trades. Every day he checks the news and reacts to market movements. If a stock rises quickly, he buys because he feels he might miss the opportunity. If prices drop, he sells because he is afraid of losing more money. He is always active, always reacting, always emotional. The second investor follows a very different strategy. He invests in strong companies or broad market index funds. Instead of trying to predict daily movements, he focuses on the long-term growth of the economy. He continues investing regularly and ignores most of the short-term noise. 10 years later, the difference becomes clear. The first investor may have made dozens or even hundreds of trades, but emotional decisions likely reduced his returns. The second investor, who remained patient and disciplined, often ends up with significantly better results, not because he is smarter, but because he avoided unnecessary mistakes. The lesson from the monkey story is not that investing is random. The real lesson is that simplicity often beats complexity. You do not need to predict every market movement. You do not need to react to every piece of financial news. And you do not need to constantly trade. Instead, focus on fundamentals. Invest consistently. Think long-term. And most importantly, control your emotions. Because in the stock market, the biggest enemy is rarely the market itself. The biggest enemy is usually your own psychology. So the next time the market becomes volatile and headlines start predicting disasters, remember the monkey. Sometimes the smartest investment strategy is not constant action. Sometimes it is simply staying calm, staying invested, and allowing time to do its work. In the long run, patience is often more powerful than prediction.